I wanted to ask more about the repo issues and what you all are doing beyond open market operations. Are you currently, for example, telling examiners not to prefer reserves over treasuries for supervisory purposes? Are you talking to the Treasury Department about maybe reducing the level of volatility in their account at the Fed? And on the standing repo facility, is it that you would be inclined to do it, but you need to figure out the details, or what would kind of drive the decision on whether or not to do that?
So on treasuries versus reserves, we've done a ton of work on that. We've talked to supervisors, and it's interesting. If you look at the banks, they're all over the place on the composition of their buffer. So you have a business model, and that business model suggests what your stress outflows will be, and that suggests what your buffer should be. And you see them making quite different choices. Some of them have lots of reserves and fewer treasuries, and then they change their mind and they switch. So it's not obvious that there's one thing happening there. Notwithstanding that, we've gone out to try to understand that, talking to the supervisors. In terms of the TGA, we have not tried to pull the TGA into this yet. We've taken it as exogenous. I don't know that at some point we won't have those discussions, but Treasury, we want Treasury to be able to have the cash that it needs, and then we are essentially taking that as exogenous to our work. There may come a time when we talk about that, but we haven't done much of that. Standing repo facility. So your question on that is, what are we thinking about it? What are we? I think we are more focused, frankly, on the bill purchases, the year end, and also the review of supervisory and regulatory issues that we're digging into, and because we think these are structural things, right? Where you could, without sacrificing safety and soundness, just allow the liquidity that is already there to flow more freely, perhaps by making fairly straightforward, non-controversial changes. And we think there is some of that, and so we're working hard and fast. But those are things, if they take rule changes, it'll take, a notice of public rulemaking. It'll take 3 months and things like that. Those things take time. These things that we're working on now, though, like, going through year end with the overnight facilities and the bill purchases and the term repo, those are things that we have to do right now and are doing.
Hi, Chris Rugaber at Associated Press. I wanted to ask, the only change in the statement was a drop in the reference to uncertainties around the economy. You seem very confident, or it implies there's a lot of confidence that those uncertainties have gone away. What caused you to make that change for this statement? What were you looking at that seemed to be so much lower?
We did actually, if you look at the statement, you'll notice that we did call out global developments and muted inflation pressures later in the statement. And why did we do that? Those are the things that we've been monitoring all year. We've put now in place policies that we think are appropriate to address those things. So we're not revisiting that. But those are just key things, and they haven't gone away. So we thought it was appropriate to mention them there. Still subject to the idea that for us to change our stance, we would want to see a material reassessment of the outlook.
Well, just to follow real quick, on the material reassessment aspect, are you worried that has set too high a bar for potential cuts next year? We were talking about rate hikes, but no Fed policymaker seems to foresee any cuts next year. Some economists do. Does a material reassessment mean you need to see data actually worsen? Does it reduce your ability to act preemptively the way arguably you did this year?
So, one thing that we're mindful of is that we've cut rates 3 times since July. That's 75 basis points worth of cuts. And we do believe that monetary policy operates with long and variable lags, and that it'll take some time before the full effects of those actions are seen in the economy. So that'll take some time. So that's one reason to hold back and wait. And we think we took strong measures. In fact, if you look at more broadly at the Treasury yield curve, it has moved more than 75 basis points. So you've had quite a significant move in the direction of higher accommodation. In terms of what is material at the end of the day, I would just say whether or not a change in the outlook merits a policy response will be a collective judgment of the FOMC. There isn't any single factor that will determine our decisions. We'll look at a full range of data and other information bearing on the economic outlook.